So traders, I want to, in this video, I want to go to more educational based, and I want to I want to give you one simple technique that I promise you that is going to help you really help you identify when the worst time to be getting involved with these markets and when there's a much more higher probability to get involved with these markets. And this is with my actual personal trading system. The way that I personally trade, I have four main trading rules that I use. And this is actually rule number 2 that I like to use. In fact, it actually helps me identify when there's a much better time to enter in on this. And so this is what I want you to do. I want you to bring on, I'm looking at the market right now. I'm looking at the daily chart. And I want you to bring up the daily chart, and I want you to bring up just one moving average. I want you to remove everything else from your screen. You don't need 3 moving averages, 3 different indicators, Bollinger Bands, and an economic forecast for you to make a decision out of the markets. When you start to have that involved, then you start to become like, what do I do? What do I do? What do I do? Right? So remember, there's 3 pillars for you to becoming really good at trading. First, it's about trade selection. Like, what type of trades are you looking for? Then it's trade management, how to cut your losses short, let your wins run. And there's what's called the 3 main pillars, but then the last pillar has also 3 pillars: the consistency, discipline, and patience. Now, when I'm looking at these markets here, okay, and when I'm trading these markets, I am always looking for a really good time to enter. So this is what I want you to do. If you look at a daily chart here, you can bring up any moving average if you want. I'm using a 52 moving average. So I'm looking at a daily chart. So right now, this is a 52-day moving average. If you trade smaller time frames like a 5-minute chart or a 15-minute chart, you can use the same thing, right? Now, why do I utilize the 52 moving average on the chart? And the reason why I like to utilize that, the reason why I like to utilize the 52 is I just learned that from one of my earliest mentors going back 20 years ago. And so I've just kept it from him, and now I just continue to use it as well. So this is what I want you to do. And this is what the reason why I started utilizing this is because I was always looking for areas of where's a really good time to enter the market. So, and where's a warning sign of to stay away because we're now too overstretched too much. So again, you can bring up any chart. I'm just looking at the S&P 500 here, or that's actually the future. You can see the future's going on right now. And then also this is the daily charts, what's going on right now. Now, what tends to happen is that if I squeeze my charts up here, right? And if I squeeze my charts up. One thing you will notice about the market and the way the markets work and they operate is that you'll be able to see that when the market starts to get stretched too far away from the moving average, they end up coming back to it, right? You can see this through, let's see if I can bring on you can see how when we start to get to these stretched places through here, even through here, through there, right? Sometimes we'll go through these big moves up, but eventually we start to become too overstretched and we end up coming back towards it, right? Too far stretched down. And I believe we're getting very close to being too far stretched down right now as I speak, by the way. So we may have a little bit more downside, but what's probably going to happen is, as you can see, the way the market flows and the way the market sort of works is when we start to get too far above the moving average, or when we start to have a movement on the downside, where we start to have too much movement on the downside, and we get away from the moving average, then that's telling me this is a bad time to get involved with this, right? So for example, if the market's going up through here, or the market's going up through here, and I'm starting to look for long signals, if I'm getting too far away from the moving average, I know then I've decreased my success rate if I'm looking to trade there. So therefore, again, this is rule number 2 out of 4 different rules that I use. If you'd like to learn my actual trading system, I'm running a webinar today. If you go to John's Free Training, or there should be that first link in the description there, click on that. You can go join my next webinar, and I'll walk you through all the 4 rules. I'll walk you through all the trade examples on the crypto market, stocks, foreign exchange, futures, like any market out there. And you'll be able to start to apply this to your own trading today. on that webinar that I'm running today. So go check it out, guys. I guarantee it's going to really, really help you. But back to this topic at hand here, okay? The one thing that I'm always looking to do is I'm always looking to make sure that I'm getting in at the right time. So I do know that in any particular market, that when we start to get too far away, I'm looking to enter that. So, and again, just you see this here. So, and we utilize this from any different particular market, right? We can look at, for example, Tesla, right? I've been looking at Tesla lately. Why have I been looking at Tesla lately? Because I think Tesla's getting ready for a bit of a bounce here. Anyway, but why am I been looking at Tesla here? Now, as you can see, look at this here. If I squeeze this, you can bring this again, bring up any market out here, right? Bring up any market and you'll be able to see how this works. And the reason why this is so powerful is because a lot of the times we like to use indicators, right? It's like the indicators are saying stochastics, MACDs, stuff like that. That's the thing that's telling us, okay, this is now overbought or now it's oversold. We should be getting cautious of that. The big issue around using indicators is, and the reason why I don't use indicators now is, one, I don't need to because of the system that I use. And again, you'll be able to see that. But the whole thing about letting your profits run, if you're going to jump on a big move, one thing I have found is that through all the really big moves that I get to have, it really does stop me from capitalizing those big moves because the indicators tend to get overbought or oversold pretty quickly. So when we're looking at this level through here, as you can see, right, you can see even on Tesla, whenever we start to get too far overstretched, right, even through here, right, we got stretched, we went sideways, had another big move up, but look what happened. We came all the way, see how we came all the way back down to it first, and then we had a bounce, and now we're starting to what? Now we're starting to be too far stretched on the downside. What does that mean? That means two things. One, if you're looking for short setups, this would be a wrong time to be going short. Why? Because you know it's too far away from the moving average and we're likely to snap back and we're likely to have a bit of a pullback towards this moving average. Again, you can use a 60. Again, I'm using a 52 because it's just what I've always used, especially when it comes to my personal trading system that I use. So we're just too far away from it. So one thing we want to do is we just want to make sure that, again, and so therefore if we can see what's happening here with Tesla, Tesla's probably going to get what? Tesla's probably going to get a bit of a bounce back soon, a bit of a snapback, just so I can get back to what's called equilibrium, right? Because the market never just goes straight up like that. Now, if it does, as you can see here, right, it went up a little bit, went up, sideways, up. When the market does do these sort of angles, what tends to happen afterwards, right? We tend to get a bit of a hard and fast snapback. This is what's called bubble territory. And this is what's dangerous if you're involved with the market that's in bubble territory, meaning it's vertical and it's going to keep going, Well, you think it's going to keep going, right? This is where you want to be careful, or you want to be cautious around that. One, if it's too far away from the moving average. But secondly, what tends to happen with these big vertical moves is a lot of them come back down to retrace almost 100% of where this move started. You can see it came down almost 100%. We're probably going to get a bit of a bounce back when we see what actually happens from there. So I wanted to share this with you guys because there's a lot of guessing in the markets, and I like to use consistency with my trading. And I like the consistency simply means the same type of setups, the same type of techniques that I'm looking forward from there. So once again, guys, this 52 moving average is rule number 2 for me. On the webinar that I'm running, first link in the description, I'll walk you through all the details. Step number 1, step number 2, step number 3. I even walk you through the exact entry bar I'm looking for. I show you examples and so on and so forth. So go join the next webinar, guys, and I hope this really helps you out. Start to apply this to your own trading, guys. And I promise you, when the market starts to get too far above or too far below, you know there's a bit of a cautionary tale about what you should be doing around that time.